Hey everyone, and welcome to today's Explainer. We are jumping right into things today because we're decoding the latest performance of an absolute titan in the real estate space, equity lifestyle properties, or ELS for short. If you follow the housing or outdoor recreation markets, you already know ELS is a massive powerhouse. But, digging into a dense financial earnings report can be, well, a little dry, right? That's exactly why we're here. We're going to translate their Q2 2026 earnings scorecard into clear, visual takeaways so you can see exactly what's driving this company right now.
So here's our roadmap for today. First, we'll look at the ELS real estate empire. Second, their Q2 2026 scorecard. Third, steady growth in manufactured homes. Fourth, flattening in RV and marina properties. Fifth, their debt and financial health. And finally, we'll be looking ahead.
Okay, let's dive into this. Part 1. The ELS real estate empire, a massive footprint. Before we start crunching numbers, we really need to understand what ELS actually owns.
Just look at that number. ELS has an interest in a staggering 173,559 real estate sites. I mean, we're talking about a sprawling portfolio that stretches all across North America, spanning 35 different states and extending all the way up into British Columbia. So when we analyze this company, we aren't just looking at a few apartment buildings here and there. We are analyzing a continent-wide network.
And here is how that massive footprint is actually divided up. The absolute largest chunk of their business is manufactured home sites, what they call MH sites, coming in at nearly 76,000. Next, you've got their RV sites, which are split up between annual, seasonal, and transient visitors, making up over 64,000 sites. And rounding it all out, they manage nearly 7,000 marina slips. So it's a highly diversified portfolio, catering to both permanent residents and vacationers alike.
Moving on to Part 2, the Q2 2026 scorecard, checking the grades. Now that we have a picture of the physical properties, let's shift our focus to the raw financial numbers.
Real quick, whenever we talk about a real estate investment trust or a REIT, we absolutely have to talk about FFO. Net income is great, sure, but because real estate on a balance sheet depreciates over time, even though the physical land usually goes up in value, net income can look artificially low. Normalized funds from operations, or FFO, strips out that depreciation and other one-time items to show us the actual cash the business is generating. It's basically the true pulse of a REIT's performance.
And guys, that pulse is beating very strong. ELS generated a normalized FFO of 74 cents per share in the second quarter of 2026. That is an impressive 7.7% jump compared to the 69 cents they made in the exact same quarter last year. The big takeaway here is that not only did they grow, but they actually performed above the midpoint of their own previous guidance. Management expected to hit somewhere between 69 and 75 cents, and they came in right at the top of that range.
Part 3, MH, steady growth, the reliable engine. So where is that outperformance actually coming from?
Well, this segment right here is the stable, reliable engine of the company. Core manufactured home-based rental income increased by 5.8% compared to Q2 of 2025. That is incredibly consistent, steady rent growth. ELS has proven their ability to consistently generate cash from this segment year in and year out like clockwork.
And the underlying business dynamics are exactly what makes that 5.8% rent growth possible. Out of over 73,000 core MH sites, their average occupancy rate is sitting at a sky-high 93.8%. Think about that for a second. Nearly 94% of their product is consistently sold out. With an average monthly base rent of $956 per site, this high occupancy provides a massive, stable floor for their revenue. Simply put, people need places to live, and manufactured housing remains a highly in-demand, affordable option.
Part 4. RV and Marina, flattening a different story. As you know, ELS isn't just about permanent housing. Let's transition over to the other half of their business, where the narrative tension really builds.
And this brilliantly illustrates the duality of ELS right now. While the manufactured home segment saw base rents rise by a healthy 5.8%, the RV and marina segment only managed a 1.8% increase in base rent compared to last year. It's a pretty sharp contrast, right? The thriving housing business is essentially carrying the slowing vacation and recreation segment. But why exactly is the RV side slowing down?
Let's look at this breakdown because it paints a really clear picture of the current travel consumer. Look at the top row. Annual RV renters, the people who park their RV at a site year-round, are still growing nicely, up 5.4%. They're actually acting a whole lot like the permanent manufactured home residents. But look at the bottom two rows.
Seasonal renters are down 11.2%, and transient short-term visitors dropped by 8.9%. What this tells us is that while long-term outdoor recreation remains super sticky, the short-term vacationer is pulling back, probably reacting to broader economic pressures or shifting travel habits.
Which brings us to part 5, debt and financial health built to last. So one engine is roaring, the other is sputtering a bit. Let's pivot to examining how ELS finances this whole empire.
In real estate, your balance sheet is everything. So, is ELS built to last? The short answer is yes. ELS boasts a total market capitalization of roughly $16.2 billion. But look at how they fund it. Only 20.5% of their capital structure is made up of debt, while a massive 79.5% is equity. In the world of commercial real estate, where companies often rely heavily on borrowed money, this is a highly conservative, incredibly resilient capital structure. To put a finer point on it, their total debt to adjusted EBITDA ratio is holding steady at a very healthy 4.4 times. What does that mean in plain English? Well, this ratio indicates strong coverage. It basically means the cash they generate from their day-to-day operations is more than enough to comfortably handle their debt obligations. Even if interest rates fluctuate or the short-term RV business continues to soften, ELS is absolutely not going to get crushed by their debt load.
Finally, part 6, looking ahead, adjusting strategy. With a strong foundation and a solid balance sheet, how are they adjusting their strategy based on these Q2 results?
So the crucial point is right here on this updated guidance sheet. Because they outperformed in the second quarter, management actually raised their full-year normalized FFO target. The new midpoint guidance is $3.18 per share, up from their previous estimate of $3.17. Yeah, it's a slight bump, but in real estate, raising guidance is always a signal of quiet confidence from management.
And here is exactly how they plan to get to that higher profit number. They've updated their growth expectations for the year. They bumped up their expectations for the manufactured housing side to 5.7%. They slashed their expectations for the RV and marina side down to 1.6%, completely acknowledging that seasonal softness. But crucially, they also lowered their property operating expense growth down to 2.1%. This right here shows great management. They're actively controlling their costs and leveraging their strong housing business to make up for the softening vacation market.
Which leaves us with this final thought. ELS has engineered a fascinating dual-engine business. One engine provides the rock-solid, predictable cash flow of essential housing, while the other captures the higher margin but much more volatile swings of outdoor recreation and travel. The big question going forward is, will ELS's stable manufactured housing foundation continue to easily offset the seasonal volatility of its RV and marina business as consumer travel habits keep shifting? It's the ultimate balancing act in real estate, and it is going to be incredibly fascinating to watch play out. Thank you so much for joining me for this explainer, and as always, keep learning.